I'm good. I'm good. I can't complain at all. Can't complain at all. Um, I hope you've had a lot of time with your textbook just to practice and get cozy with what we've done thus far. As I was speaking to the guys a bit earlier, I hope you've started with your what's this assignments, because we've done everything necessary for that. So there's no point in putting it off until the last minute. So I hope you've already started. All right. And then yeah, as you guys know, today we're getting into Unit 5. Yeah, and then the next time I see you, we'll probably be finishing up Unit 5. I think it might be online, I don't know, or face-to-face, but whenever next I see you, that'll be the end of Unit 5. We did Unit 4, okay? And then at that point, you guys will be ready for Test 2, because Test 2 is Unit 1 to 5, okay? And we'll be primarily focusing on your VAT calculations and the journals, okay? But that said, let's get into our Unit 5. Let's get into our Unit 5. So Unit 4, we were talking about recording cash transactions. Now with Unit 5, we're talking about recording credit transactions. Okay? We're talking about recording credit transactions. So once again, always like to throw this in because it reminds us where we are in the whole bookkeeping process. We've dealt with different transactions that we could typically get. We now know what source documents are. I gave you guys an ICE task that also made you, apply yourselves in terms of what it means when we get certain source documents. Then obviously we've spoken about the journals, all right? And now today we're going to be talking about credit journals, of course. We did speak about the credit journals, but today we'll actually be playing around with them. And we did talk about the general ledger and obviously then the trial balance. Okay, so this is knowledge that we do know, all right? So we're not going to revisit the journals, at least not going to revisit all of them, okay? But just as a quick recap, you've got the Creditors Journal. Creditors Journal is for whenever we make a purchase on credit, whenever we buy from somebody and we don't pay cash, we promise to pay them over time. Okay, we purchased on credit. That's the Creditors Journal. Then the Creditors Adjustment Journal or Creditors Allowance Journal, same thing. They were talking about whenever we return goods to a supplier or any business that we bought on credit from, all right, whenever we return goods back to them or ask for a rebate, all right? I did explain to you guys what a rebate is, right? Whenever we go back and say, look, you sold me this chair. It's a bit damaged, all right? But I'm willing to keep it. So I'm not going to pay 2,000, but I'd rather pay 1.5. I think that's good, okay? So that 500 is then the rebate. It's like a discount, but not necessarily. That's it. Okay, so we call that a rebate. If I bought a phone and for some reason it's not functioning as it should be, this key is not working as it should be, or whatever the case may be, all right, sometimes it just switches off or the battery doesn't last as long as it should. Okay, I'm willing to keep the phone, but I'm not willing to pay the price that you quoted me. I'd like 200 Rand less. Okay, once again, that's a rebate. Okay, so that whenever we have those type of transactions, we record them in the Creditors Adjustment Journal. Then we have the Debtors Journal. And in the Debtors Journal, this is whenever somebody buys goods from us, all right, and this is trading inventory only on credit, all right? Whenever somebody buys goods, should I say trading inventory from us or stock from us on credit, okay? Then you've got the Debtors Allowance Journal, and that's now just the opposite of the Creditors Allowance Journal, right? They were saying, okay, now it's a customer who comes to us and says, I'm returning these goods, or they want to rebate, okay? So that's your Creditors Adjustment or Creditors Allowance Journal, all right? And then the last one that we didn't play around with in Unit 4 is the General Journal. Okay, and we will be seeing that today. Okay, and the general journal, remember, is for all those transactions that we can't enter in any of the other 7 journals. Okay, so even those cash journals that we played around with, when we can't put a transaction into that, we can't put a transaction into the creditors journals, then we put it in the general journal. Okay. Then here they're just highlighting the fact that credit transactions are transactions where somebody owes somebody at the point of sale after the transaction has been done. So in other words, somebody's bought something on credit. Obviously, they leave with the goods out the store, but they still owe whoever they purchased the goods or services from. Okay, so that is credit transactions. And then debtor transactions increase the balance of money owed to the business. Okay, that's why we call it the debtors journal. That's where we enter, where people buy from us on credit, because now more people owe us. Then creditors journal, creditor transactions. Opposite, increase the money that the business owes. Okay, and I'm sure this shouldn't be too much of a surprise for you, because you guys obviously touched on, well, you've obviously played around with the creditors control and debtors control, so that just comes together nicely. All right, then extending credit lines. Why? Why would we want to extend credit? Okay, to build a closer relationship with clients. All right, obviously, I don't have the money to buy from you cash, but you're willing to give it to me and I can pay you later. That's obviously going to foster a good relationship. Ensure the edge against competitors. If your competitors are not offering credit, but you are, guess what? More people would be attracted to doing business with you than that of your competitors, all right? Then you have other credit, offer credit like that of your competitors. Now, if your competitor sees that you are offering credit, if they want to compete with you, guess what? They're going to start doing the same. Or vice versa. If you notice that your competitor was offering credit initially, all right, to ensure that they don't steal market share from you, you're going to start doing the same thing, okay? And then want to sell directly to the customer, all right? Sometimes, this is how retailers sometimes function. Retailers say, okay, you know, the wholesaler typically operates in bulk, all right? So when they sell to the retailer takes on that bulk because they know they're going to package it into smaller packages and then sell it to us, the typical client. So for instance, if I use toothpaste, for example, so Colgate will sell in bulk, loads of boxes, but we don't need a whole box of toothpaste. We'll just go buy 1 or 2 at a time, right? So that's why we go and buy from the retailers, because you can get them 1 or 2 at a time, all right? With wholesalers, typically, you may find yourself having to buy in bulk, okay? So, because of that, they could typically be more expensive, all right? Because you were looking to just buy one, and here you are being forced to buy a whole box, for example. Now, how then can they still be attractive to you? Because you know what, this is something that's not going to expire anytime soon. I might as well buy in bulk, okay? Yes, it costs me more, right, in the meantime, but I'm going to use it as something, okay? You can buy for the year, all right? Same thing with tissue. Tissue is not about to expire. Why don't I just buy for the year or buy for 6 months? You know what I mean? So, to make it attractive for you to just buy directly from them, what they can do is say, you know what, you don't even need to pay all that money upfront. You can actually pay it over 6 months. See how it's now beginning to make sense? Okay, so that's how now you can skip the retailer and then obviously deal directly with your customer. Okay, and then here, you guys can read this in your own time, but offering credit is an advantage to the customer because obviously it allows you to manage your cash. Okay, you can say, I can't pay 6,000 upfront, but I can pay 1,000 over 6 months. All right, that won't hurt my budget too much. All right, then customer relations will improve with mutual trust. Okay, obviously me paying you, you will trust me, and likewise, obviously I have a better relationship with you because you offered me credit, okay? And then with credit terms, it is possible to approach stronger customers, okay? And then the next one, they say credit will make it more likely that you can deliver goods directly to your target customers instead of going to trading companies in between. Okay, so we spoke about this just a minute ago. And then logistics will be smoother as goods can be shipped when ready and not after clearance by the bank. Okay, so you know when you're operating for cash, it's tit for tat. You give me the cash, I give you the phone. Until the money reflects in my bank account, I'm not giving you the phone. Does that make sense? But if we've agreed credit terms, it's like, okay, cool, you signed, we're all good to go. I can give the phone or I can give the service. So that's what they're talking about there. All right. And then more sales revenue. The reality is, if you're offering credit, basically telling people you can leave with this thing and pay for it later, more people are actually going to buy from you because it's like, okay, I didn't necessarily have that in my budget, but since I can pay for it over 6 months, over 12 months, let's go. All right. So you're going to make more sales as a result. Okay. And then repeat business. All right. Some people, unfortunately, all right, we tend to start to get a bit too comfortable with buying on credit. And so we end up buying things we also don't need. But that's an advantage to the business, okay? Because that's repeat business. Okay. Now there's also disadvantages to this whole thing. For the business, you can have cash flow problems. All right, and this is particularly if you don't manage your credit policy well. Okay, so cash flow problems in that I've sold to all of you guys on credit. All right, you obviously haven't all paid me, and some of you might pay me, some of you might not. Okay, as a result of that, right, I'm unable to actually go and buy more inventory to stock in my shop, or I'm unable to pay wages, or I'm unable to pay for rent, water and electricity, etc., etc. Okay, that becomes a problem because then I cannot operate as I should be able to. Okay, right. So that's where if you don't manage your things well, there's a huge risk of that. All right, risk of non-payment. Okay, some people might just not pay, right, for various reasons. Some might just never have actually or had planned to actually pay back. Some might fall on hard times and be unable to pay back. All right. So they may have started off on the right note and then suddenly they just can't. All right. These are realities. Okay. And that's the risk that you take on by offering credit. So that's a disadvantage. Then leverage. What are they talking about there? When they're talking about leverage, if you sell me these glasses on credit, right? Tested my eyes and everything seemed fine. But then at a later point I say, no man, these glasses are giving me headaches and this is not right, that is not right. You know how customers can be. And I haven't fully paid for the glasses. I'm in a position of power because it becomes a thing of, you know what, I'm so desperate for this guy to pay, I'm just going to make him happy so that he pays, even though it's not on us to actually do 1, 2, 3, 1, 2, 3, but just for the sake of ensuring that we get our money back, we're going to try and make a customer happy, right? So can you see that sometimes can be disadvantage for the business, okay? Because I could then say, look, if you don't want to do what I feel I should be entitled to, take your glasses back. I don't want them, okay? And you have already spent money in obviously cutting out the lenses and giving me the frames and so forth, so forth. So that's the disadvantage. The customer has leverage in such situations. Okay, then you've got credit risk. Currency risk. Currency risk is typically if you're exporting your goods, if you're selling abroad and things like that. So let's say we're selling African ornaments and stuff like that. Okay, if we're selling African ornaments and things like that to America, they're paying us in dollars and stuff like that. you might find yourself in a situation where, because we sold on credit to these guys, they are paying us over time. Okay. Now anything can happen to the rand. Okay, against the dollar. All right. So in other words, the rand might get stronger against the dollar, so it'll be cheaper for them because we quoted them in rands. Okay. But at the same time, if I'm buying my stuff from America, right, my raw materials, it's going to be more expensive for me to restock. Does that make sense? Or my profits are going to be thinner, right? So can you see where the currency risk now comes in? Then finally, organizational change. If you want to offer credit in your business, you're going to need to set up a credit policy. And as a result of that, I'm going to need to get some of my staff or employ new staff and say, okay, so your job is to do a credit check on these people, is to check how much disposable income they have, what are their expenses and income, to really assess, are they credit worthy, can we actually give them credit? And then, after you approve them, assuming that you can actually approve these individuals, you then also need to go on to say, but wait a minute, we also need to follow up with these guys. So have you made your payment? We haven't yet received anything. Need to send them letters, etc, etc. All right, if they're totally not paying, we need to start engaging lawyers. So can you see, your organization is going to change as a result of saying, okay, we now want to offer credit, because you obviously have to set up credit controls and policies and things to that effect. Okay, right, awesome stuff. All right, so let's proceed. So those are the advantages, disadvantages, and here we're just talking about the credit journals, okay, which we spoke about a little earlier on. All right, then examples of credit transactions. Oh, sorry. CJ transactions. Okay, like I said, credit purchases of trading inventory, credit purchases of non-current assets, credit purchases of consumables. All right. The recording of expenses incurred on credit but not yet paid for. All right. So when it comes to the creditors journal, it could literally be anything that we are buying on credit. Creditors adjustment, like I told you, it's for rebates and it's for returns. All right, from us, the business. Okay, remember when I said, when I say us, when I say we, I'm talking about the business. Okay, right. Okay, now the debtors journal, we spoke about this as well. So whenever, it's only for inventory. It's only for inventory. Okay, when somebody buys from us inventory. Did you put your hand up? Oh, cool. Right, and then the debtors allowance journal, rebates, returns. Okay, all right, and there you can see the structures, but you're going to see the structures as we play around with this stuff, so don't need to bother about that now. All right, and then general journal. Like I said, we use this to record any transaction that doesn't go in any of the other journals. Okay, it's got a completely different structure to the other journals, but we'll have a look at that. We'll have a look at that just now. Okay, one thing I wish to highlight to you guys, all right, is the general ledger reconciliation statement. Now, when I look in the new textbook, they don't actually have this section. So I think chances are they're not going to examine you on it because they don't have this section. I actually liked it, but well, they didn't really usually ask about it too much anyway. So I'll leave that out. I'll leave that out. So that is the theory to Unit 5. Okay. Now, what I want us to do is to open our work packs. I hope you guys brought those along. If not, at least I know it's on the WhatsApp group. So I want us to do activity, what is this, 19? ABC traders. In the work pack, I want us to go through that, complete that, and then we'll call it a day. Okay. questions or thoughts? Any questions? Thoughts? Simple, né? Accounting is easy. It's just accounting. I'm hearing strange sounds somewhere there. Somewhere there. Huh? Yeah. Okay. Cool. Is everybody there now? Exercise 19 in the Workpack. By Workpack, I mean this document. I don't know if you... Are you new? Am I seeing you for the first time?
I actually changed from BBC to Book One.
Really?
Yeah.
Why did you do that?
Time.
You can't?
I can't use the website.
Oh, I see. Okay. Wow. Who's admin on the WhatsApp group? You. You raise your hand. Okay, I should continue to wear my glasses. See? Everyone's admin. Could you please add it? And then if we could share that this Workpack again. Are you a part of my group? Oh no, not you guys. I mean, as in, are you part of my group on BC Learn? You know, BC Learn, the portal, where, yeah. The Workpack is also there under lecture slides or under more resources. It's called, I think, a student extra Workpack, something like that. Okay, guys. So please, we're going to exercise 19, all right, in the Workpack. All right, I can see a lot of you haven't got it printed out, so please, can you please open that up on your phones? We need to go through this thing together, okay? And the reason why we're doing this together is so that when you do your assignment or you do your exam, you now know how to approach it. Okay? So this is an extra thing on the exam. Right? So we worked with the Workpack before.
Yeah.
So you know where to find it, right?
Yes.
All right, cool. So let's jump into this. Okay, there we go. So we have quite a few transactions to get through today. Okay, but as always, the first thing that we want to do is we want to read the required to find out what is going on here. Under the required, they say use the relevant transactions for those given below to complete the necessary journals for the month of October. Cash payments journal, cash receipts journal, debtors journal, debtors allowance journal, creditors journal, creditors allowance journal, and then the general journal. Okay? So we're not going to do the cash payments journal and the cash receipts journal. Why? Because we've done it. Okay? So you should be comfortable with that. If you aren't, remember the videos are all uploaded. So go on and conquer that. Okay? Go on and conquer that. Then, so we know what is required of us. The next step is then to go and read the above information. Exercise 19. You are the bookkeeper of ABC Traders. The business is a registered VAT vendor and trades only with registered VAT vendors. That is charged on all sales, okay? Remember I said, wherever you see 14% in this Workpack, just imagine that you are seeing 15%, okay? Because your tests, exams, everything will be on 15%. All right, it says all amounts are inclusive of that where applicable. As a bookkeeper, you have been provided with only the source documents for the month of October 2016, necessary for the preparation of the journals specified below. The business uses the perpetual inventory system and uses different markups for different products that they sell. Okay? Then they tell us DIN, DCN, DCF, S, RT, JB are the source document codes for the duplicate invoice. So DIN is duplicate invoice. DCN is duplicate cash notes. DCS is duplicate cash slips. And then RT is duplicate receipts, check counterfoils, and journal vouchers respectively. Okay, so they forgot to add check counterfoils. Check counterfoils is probably CC. Yeah, it's definitely CC. Okay, and then IB, OCT, and CC are the source documents for renumbered original invoice, renumbered credit notes, and check counterfoils respectively. Okay, cool. So we have that. So you know what I even did? I actually wrote quickly on the side. EIN, duplicate invoice. Yes. I don't know because my pages are different from yours, but it should be 41. Okay. Awesome. Right. So now we know that the next step when it comes to the journals is to then actually read through every transaction, know which journal it's supposed to be in, right? And then we can jump into our transactions. So let's do that. Okay, on the first, it says cash sales of merchandise, right? Markup 20%. But then can you see under source? The reason why I always start by reading the description with you guys, okay, even though we have the source, is because a lot of the time they don't actually give you guys the source. Right? Sometimes they don't give you the source. But via the description, you should be able to tell most of the time where this should go. Does that make sense? So I'm trying to train your mind to already pick up which journal it should go in. Okay? Alright, so cash sales of merchandise. We know this is the cash receipts journal because whenever we receive money, we put in the cash receipt. So they're right next to it. Okay? So this is what I've been training the guys to do, is that we just put CRJ next to it. So I think you can put it on a piece of paper. Obviously, a lot of you guys are on page 4. So just put 1 and then put CRJ. So you know, transaction that happened on the first is for CRJ. Then on the third, all right, it says purchased trading inventory. Okay, can you see that it didn't say whether it was purchased on cash or on credit? So now you need to go to the source to double check. And then you see IB. Okay, what do we know IB stands for? Original invoice. So, by virtue of it being an original invoice, which journal should this go in? Which one? It's an original invoice. No. CPJ? Nope. An invoice means that something was done on credit. And whenever something is an original, what does that mean in the transaction? Were we the customer or the supplier? When it's an original, we're the customer. Okay? Because remember, the customer always keeps the original, the supplier keeps the duplicate. So if what we have is the original, that means we bought on credit. Does it make sense? Since we were the customer, it means we bought on credit. Okay? So if we bought on credit, which journal should we spoke about this just a second when we did this last. Yeah, we bought on credit. You said it. Creditors journal. Okay, so this is going in the CJ. Okay, right. Then we go to the next one. It says Apple purchased stock. Okay. Again, it doesn't really say was this on credit or was this for cash. It just says they purchased stock. Okay, and we know we're ABC traders, so this is not us. But there you can see other source is DIN. So this is duplicate invoice. So if it's a duplicate, what does that mean? We were suppliers, 100%. All right? So somebody bought from us on credit, right? So then, which journal should this go in? 100%. Okay, so put DJ there. All right? When we go to the next one, it says paid on account 2000 and purchased goods 30,000. Okay. If you look there at the source, you see CC. So that's check counterfoil. So which journal should this go in? Yes, you're right. Okay. It's going in the cash payments journal, all right? Because we paid. Check counterfoil means we wrote out a check. We spent money. Okay. Then next one. Withdrew merchandise. Okay, and there you can see Andile owner. All right. So in other words, this is drawings, but this is drawings of stock. So if it's drawings of stock, what that means is, well, what that means is the owner took stock out of business, right? But now, where do we record this? Definitely can't be the cash payments journal, because cash payments journal is when the owner takes money out of the business. All right. Petty cash, when the owner takes cash out of the business, all right, from the petty cash box. So since it's neither cash, it has to be the general journal. It can't go into any other journal, all right? So that's GJ. Then the next one is sale of goods, all right? And then you can see duplicate cash slip. So we know this is which journal? CRJ, 100%, okay? Go to the next one, sold to debtor. Okay, that's obvious. All right, that's definitely the debtors journal. Okay, then the next one, received cash from tenant. Received cash from tenant. That's also obvious. CRJ. Whenever we're receiving cash, you know it's CRJ. All right, then the next one, purchased stationery. Okay, can you see? They didn't tell us whether we purchased the stationery out of the petty cash, whether we purchased the stationery on credit. So we need to look at the source. And we look at the source and we see CC, therefore CPJ, all right? Then we go to the next one, inventory bought. Again, they didn't tell us, did we buy it on cash or did we buy it on credit? We look at the source, what do we see? IB, which stands for? So which journal? CJ, 100%. Okay. Then we look at the next transaction on the 15th. It says corrected overcharge. Okay. On the 3rd. DCN. Oh my word, what does that say? Duplicate credit note. What is a credit note, guys? What is a credit note? You guys did the exercise, right?
Maybe when you return something, like they giving the customer credit when they return something.
100%. So a credit note is whenever someone is returning a good or a rebate. That person will get a credit note. Now, here they told us it's a duplicate credit note. So were we returning something or was someone returning something to us? Someone was returning something to us. But in this case, what's really happening here is, can you see, it says corrected overcharge. So basically we're just acknowledging that we overpriced. Make sense? I overpriced you and now we're like, okay, let's fix up the books. All right? 100%. Okay? So, which journal is this supposed to go in? Since this is a duplicate, and we've established that means someone was overcharged and we're trying to rectify that. Which journal should we put this in? Debtors Allowance Journal, 100%. Okay. Then we go on to the next one. Paid wages, again we see CC, so that's cash payments journal. The next one, trading inventory bought, then IB, so that's definitely creditors journal. The next one, sold merchandise, again DIN, so duplicate invoice, meaning we sold to someone on credit, therefore debtors journal. Then client returned damaged merchandise. So can you see, the moment you see client returned damaged merchandise, you know this then has to be the debtors allowance journal. Okay. And there to just double check, you see there duplicate credit note. That's what you know. So DAJ. Then the next one, purchase more merchandise. Okay, DIN, duplicate invoice. So which one? This is the Debtors Journal. All right. Can you see how that could have easily tricked you? Because since you're seeing purchase, you automatically might assume we're the ones buying. Okay, so you just need to double check the source. Purchase equipment, okay, IB. So that's original invoice. Yeah. Original invoice. Sorry, I just can't read it. Nope. Because it wasn't for cash. This is an invoice. Yes, CJ. Okay. Then pay telephone account. Which one is that? You can see CC there. CBJ, 100% guys. Okay. Then return damaged equipment. OCT. Okay. And that stands for original credit note. Return damaged equipment. So what's going on here? CHA, 100%, because we're the ones who are returning. Because you see, it's an original credit note. That means in this transaction, we were the customer. So since we have the original, we were the customer. That means we were the ones getting the credit note. That means we were the ones returning goods, all right, or returning damaged equipment. Then the next one we have paid wages, again CC. So that's cash payments journal, paid rates. All right, 500, and electricity 1,315. Again, CC, so that's cash payments journal. All right, payment of account. Can you see that? Who's paying? Who's paying? These guys aren't telling us enough. They just said payment of account. Are we paying an account, or is someone paying their account with us? What's going on? How do you know that? RT. And what does RT stand for? Exactly. So you're 100% right. Someone is paying us. Okay? So which journal should this go in? Yes. What is it? Yeah. CRJ. Because remember, CRJ is whenever we receive money. Okay? From anybody. Okay. Then, last one. Full payment of account, 10% discount granted. Okay. Now things are getting interesting. Now things are getting interesting. Again, there you see RT. So that means someone was paying us. Someone was settling their account. Does that make sense? And we granted them a settlement discount. Okay? So what does that then tell us? That then tells us that we actually have two journals that we need to report this. The CRJ for the money that was received, and then the general journal to record the settlement discount that was granted. Okay? Okay? Alright. Then, and another way that you can pick up that this is a settlement discount and not a trade discount is the fact that they said full payment of account. Alright, 10% discount granted. Remember, the trade discount is given there and then. It's not given at a later point. Okay, so here we're only giving it at the point where this person is settling their account. Okay. Then we go on to, so I lied, I didn't know there were transactions on the other page. 28, it says overcharge correction. Then it says 13. So when you see dates like that, it also just gives you a reference point to who got overcharged. Okay. And here you can see the source OCT. So that's original credit note. So again, this is the creditors adjustment journal, because that means it was us who were overcharged. Then finally we have Uplands, and there's full payment in full, 5% discount. it's supposed to be received there, not granted. Right? It's just a mistake there. It's supposed to be received. Let's take note of that. And that is for the CP check. Since it was received, it means we're the ones who are getting the settlement discount granted. All right? So what's happening is we're settling our account with someone we owe, but then at the same time they're giving us a settlement discount. Why do people give settlement discounts again? Because they're encouraging you to pay up your account early. Instead of paying it in 6 months, they say, if you pay us in 3 months, Aubrey, we will pay, you can pay 80%, or you can pay 90% in this, or in this case, 95%, as opposed to the whole 100%. Okay? So, I think I probably said it already. So this is going to be your cash payments journal, the money leaving us, the 95% leaving us, then the 5% discount, again, you record that in the general journal. Okay? Then the last one, part payment of account. Okay, and there again we have CC. So that tells us that we need to record that in the cash payments. All right, awesome. Now that we've done that, we can now jump into our transactions. Which journal are we going to start with? You guys pick. You guys tell me. Are we going to start with Debtors Journal, Debtors Allowance Journal, Creditors Allowance Journal? Yes? All right. Debtors Journal. Okay. So then let's get cracking. And now can you see, this is why I was telling you guys to adapt this strategy. Now we go to every transaction where we wrote down DJ. Okay, it just saves us that time. And I don't think I mentioned this enough. Whenever we then deal with that transaction, cancel it out. So that you know, okay, I've dealt with this. Right? So you never have to go back to it. There's no confusion. Okay? Just gives you some extra time there in the test or exam. Okay? Right. So the first transaction we know happened on the 3rd. On the 3rd. And what was going on there? Let's quickly see. Purchase trading inventory. Okay. Nope, that's not the one. Yes, 100%. It's the Apple purchased stock. So there, we know that this is the VAT inclusive amount. And much like when you're in the cash receipts journal, okay, this is pretty much the same as the cash receipts journal. The only difference is we're only dealing with sales of trading inventory, and we don't have a bank account. We have a debtors column. Okay, can you see that? Remember when we did the accounting equation, if we sold on credit, we said debtors is affected, not bank. Okay, here we're seeing that. So you come to your debtors and you say, okay, how much was this amount? It was 12,790. It's the VAT inclusive under the debtors column. Then we say, okay, whenever we make a sale, we know that we owe SARS. So what do we need to do? We now need to calculate how much of this belongs to SARS. So then we say, okay, cool, no problem. What we want is the VAT exclusive. Oh, so well, actually we want the VAT because I said how much belongs to SARS. And we know this is the VAT inclusive. How did my cursor end up all the way up there? All right, and then we say times this 12,790. And what do we get? Okay, so 1,600. And what do we get as VAT? Then obviously, the difference between the two, the VAT inclusive and the VAT exclusive, will then be the sales amount. Because remember, sales is VAT exclusive. Okay, let's quickly calculate that. And there you have it. Okay, by now I'm hoping you guys are comfortable with these calculations. All right. So now we have that. The next step, remember, like in the cash receipts journal, we then now need to calculate what was cost of sales. Remember, whenever we make a sale and we're under the perpetual inventory system, we also need to say what then is the cost of sales for that transaction. So here we know we're using the VAT exclusive amount, and we're saying, remember they gave us the markup. They said the markup was 20%. Okay? And remember, I told you guys, if they don't tell you whether it was on cost or whether it was on selling price, like they've done over here, you then now need to say, what's the formula for markup? Somebody tell me, what's the formula for markup? Say it again. Okay. Okay, yes, you are right in saying selling price minus cost price, because that's going to give you the profit, which in actuality is then your markup. But now the formula I'm looking for is the markup percentage, sorry, just to be clear. Markup percentage. Remember, profit divided by cost divided by cost times 100. Okay, so can you see, because it's on cost, we can then say profit is on cost, we can then say cost is 100. And I've just put these models up here, so just to save us some time, which you can see here. Okay, so we then say, okay, what we want is cost, which is 100. What we have is 125, the selling price, exclusive of that. So then, what then is our cost? There we go. Guys, can you see clearly what I'm doing? Everyone can see clearly. I don't need to zoom in. Okay, cool. Right, so here's our cost of sales. Okay, right. That's transaction number 1. Okay, then the next transaction that we have for the DJ happened on the 7th, and there we sold to a debtor 15% markup. Okay, that was for 14,400. Again, just come here. 14,400. We know that's the VAT inclusive amount. Then we have to do the same calculations again. We say, okay, what is the VAT? And again, you guys could start with the VAT exclusive. It's perfectly fine. No problem. All that matters, all that teacher wants to see is that you get the right answer, period. And put it in the right place. And there's happiness from there. Okay. Right. Okay. So 14,400 minus the VAT amount. Okay. This is the VAT exclusive at 12,521. Cool. Then we say we need to calculate cost of sales. So let's do that. This time they say 15% markup. So again, we know cost is 100%, profit is obviously 15%, and then the selling is 115. So 100, what we want is the cost. What we have though is 115, the selling price. Okay, and that gives us 10,800 and okay, round it up to 47. Okay, just doing things to 2 decimal place. Okay, then the next one we have the, what is this? Next transaction happened on the 15th. Okay, on the 15th with Ace Wholesalers. Is that the one? Nope. With A Apple, we sold merchandise to them. This time the markup was 30%. Okay, the amount is 25,650. Cool. Okay. Then we say to ourselves, okay, we want, okay, let me for once do the VAT exclusive rather. Just to show you there's no problems, we can do it either way. Okay, copy and paste. Where would we be without technology, huh? Okay, 35. Okay, then again, the VAT exclusive minus the VAT inclusive will give us our VAT amount. Okay, and again, guys, if you want to, you can do all these calculations with the formula that I taught you guys. It's perfectly fine. I'm just doing this just to save us some time. But I know a lot of my students find it easier to actually calculate one and then just do the whole subtraction thing. So whichever way, so as long as you get where we need to go, that's perfectly fine. Right. Then what we want to do again is quickly calculate cost of sales. And there, remember, the markup was 130%. So here we're saying 100 divided by 130, the selling price, percentage, times the VAT exclusive amount, and voila, we have our cost of sales. Okay. Can I do this last one, or do you guys want to break? You can do the last one? We're saying break. Okay, all right, let's just finish this journal and then we can then have a break. All right, B banana on the 17th. Okay, that's the 7,400. Okay, so let's plug that in. Okay, and then 7,400. What we want is the VAT exclusive. What we have is the VAT inclusive. Okay, right. There we go. Plug the VAT exclusive into sales. And then we calculate the VAT. All right, so can you see it's very much like the cash receipts journal in terms of calculations. The only difference is we don't have analysis of receipts here as well. All right, so it's slightly less work. Okay. Slightly less work, which I'm sure we're not complaining about. Okay, and that's 22 cents. And finally, we want to calculate the cost of sales. Copy. How are we going to do that? The markup there, what did they say the markup was? Oh, they actually said gross margin. Gross margin. Okay, so that means that our selling price is now 100%. Once again, they didn't say whether it's on cost or on selling price. So we say, okay, gross profit, percentage. The formula, we know it's profit over selling price. So since it's on selling price times 100, okay, since they didn't tell us whether markup or gross profit percentage is on cost or on selling price, we have to go to the formula. Okay, so then obviously selling price, can you see here, is 100%. We know markup, or profit in other words, is 10%. So then cost is 90. So in this scenario, we're saying, what do we want? What we want is 90. What we have, however, is 100. Okay, then we say times our selling price exclusive of that. And this is what we get. 5,700 and what. And we plug that in. And ladies and gentlemen, we have our debtors journal. Right. So are there any questions or thoughts before I let you guys go? Everybody happy? All right, so guys, let's take our break, and then I'll see you guys at 9:05. Finish off this exercise, and then we'll call it a day.